Hey, good morning, everybody. It is Monday, the first part of February, and we're already started off to a very cold week. Wanted to talk to you today just a little bit about refinancing. Yes, we see that the rates are doing really, really well, and it very well could be your time to refinance. But remember, it doesn't always pay, and it always doesn't mean getting the lowest rate. What do you mean by that? Well, first of all, if you've only been in your home a year, maybe two, you may not have built up enough equity to get rid of mortgage insurance if you currently have an FHA loan. You have to have 80% loan to value. What's that mean? It means that your home has to be worth more by basically 120% of your loan amount. For instance, if you had a $100,000 home and your loan was $80,000, you could refinance with no mortgage insurance. Now, other ways to refinance and save money are a streamlined refinance. FHA and VA both offer a program that you can refinance your existing loan and literally not even have an appraisal, not have an income validation. You don't do anything. And all we do is verify that your mortgage has been paid on time in the last 12 months. Pretty simple process. Now, yes, usually you have to bring in a little bit of money to close. Most refinances, they say, hey, look, you're going to skip a month's payment. Yeah, you're going to not make that scheduled payment for a month, but you probably have to bring in an amount just about equal to that. The guidelines for a streamlined refinance are very tight. The calculations don't let you finance much of the closing cost into it, but it really does work out. It depends on exactly what you're trying to do. That's where we come in. If you give us a call or email us, we'll be glad to look at your scenario. Now, always refinancing doesn't have to be the lowest the rate. A lot of times it's called debt management. Yeah, that's an ugly word, we know, but sometimes people just have a habit, and for unknown reasons, life throws different things at us. But credit card debts have really gone up. You have student loans, for instance, that are starting to become payable. Those types of things can be managed through equity. And a lot of times by getting a lower rate, pulling out cash, you can actually combine some of that debt that doesn't make sense, that has high interest rates, big payments, into one overall smaller payment. Now, it does take away some of your equity, but in a good way. You still owe the same amount of money, but your credit cards were 20% interest and a new mortgage is 3.75. Kind of see where I'm going? It can make sense. All of that saying, it is your individual situation that we need to look at. So give us a call and we'll go over every single part of your guidelines that require anything that we need from you to make that determination. And we'll give you a good plan, whether it makes sense or whether it doesn't. Give us a call, 209-639-7426, or you can always visit our website at www.ralphgresham.com. Have a great week. Try to stay warm and dry.